And welcome back to Cryptocurrency Trading, Mastering Scalp Trading Strategies by Wealthy Education. In this video, I'll begin Module 5, Risk Management and Trade Execution, with a video on how to perform multiple time frame analysis. Now, this is relatively simple. Unfortunately, I think a lot of new traders don't understand how important this is. So what I have in front of you is a weekly chart of Bitcoin. You can see that we've had the couple bubbles that popped. There was this bubble here, this bubble. And, now we find ourselves, you can take a look at this and you can see that you can make an argument that we're kind of at an area around 30,000 that's crucial. And on TradingView, you can see that the baseline, and the baseline is just a type of charting that will change, like where the midpoint is of what you're looking at. So basically, the baseline is somewhere around 32. That's the average price. So we're definitely in an area that people are going to be paying attention to. So why am I bringing this up? Well, I'm bringing this up because this is how you have to look at the market. You have to have a longer-term bias first before we can have a short-term bias. Certainly looks like somewhere around 30,000 is going to be absolutely crucial, right? But unfortunately, a lot of retail traders will just get in and say, okay, what's it doing right this second? This is a 5-minute chart. How should I be trading this? What you want to do is you want to have an idea of the big picture. The big picture is we have seen a really massive rally in Bitcoin, but we're right in an area where you would expect to see some trouble. When you look at the daily, you can see that we're right in this area of consolidation. So despite the fact that I'm going to pull up an hourly, and an hourly, it's like, wow, look at how great this looks, and we're consolidating. 4 hour, kind of the same thing. Daily, kind of the same thing, but rolling over. So what you need for more confidence is you need everything pointing in the same direction. And you do have some concerns on the daily and the weekly. The hourly, if we break through here, that obviously would line up with the bearish thesis as well, that the sellers are coming in. So this is very crucial. Go ahead and take a look at Ethereum. Quite frankly, most of crypto is going to look very similar. It all tends to move in the lockstep. This is Ethereum. In Ethereum's case, you're probably looking at a 2,000 level. That's going to be important. It's not too difficult to see that. The daily chart has been grinding up to here. Looks positive from here to here, but overall, does it really look positive? Probably not. 4 hour chart. It looks like it's running into some trouble here. Hourly chart looks a little better, but it looks sideways as of late. And the problem is on the 5-minute chart, it looks extraordinarily negative, but on the daily chart, it looks consolidation. So that is the problem as a trader that you need to overcome. You need to look out bigger time frames. So the 2,000 level, for example, on the weekly chart was important, as I mentioned. And, notice how we shot above there and then broke right back down. On the half-an-hour candlestick, for that area, look at that perfect shooting star. So again, you have to look bigger to start trading smaller time frames. And unfortunately, a lot of traders will just stick to one time frame. What you want, the best setups are always going to be when everything points in the same direction. So here is Cardano. Now, without me telling you this is crypto or Cardano or anything else, does this look like something you want to own? It looks miserable. Yes, it's rallied for a while, but now it's turning around again. Daily chart. Does this look like something that's going to go a lot higher? Not really. Looks like it's rolling over. 1 hour chart. 15-minute chart. It all looks weak. Looks like it's going lower. So that sets up your bias for Cardano. Then what you look for is signals on a scalping time frame. So for example, right here is an area right around 36 that it looks like the market's paying attention to, 36.5. Form this big shooting star and you short it. You know, down here, you got a bit of a crossover. Here you got this nasty candlestick and we broke down below it. And the moving average is crossed at this point. Certainly looks like you've got a scenario where market participants see a lot of volatility, but you can't read too much in this move when you've got this move working against it. So while trends do change, they don't change that quickly. You can see that Cardano has been in a downtrend since August 23rd of 21. So it's almost 2 years. You could have sold at any point over the last 2 years, with the exception of a couple of weeks, and just held on to your short position and made money. And that's how you have to look at this. You cannot ignore the higher time frames. Take a look at one more. Phantom. I mean, look at Phantom. It's a mess. It looks like it's breaking down here. This is your weekly chart. This is your daily chart. This is your 1 hour chart. Now, see, unfortunately, there are people out there who will say, well, maybe it'll find a little support here. But I postulate it's going down to there. And on the 5-minute chart, people say, well, it's consolidating. You're going to have the weight of the market with sell signals. This shorting sell signal here was a beauty. Is there any reason to think it would have lined up? Yeah, right there. Furthermore, there's your MACD crossing over right there as well. Let's do one more. Doge. Doge has been miserable for a long time. I mean, look at this chart. This is miserable. And notice how, if you just looked at a line chart, I mean, does that look like something that is going to suddenly explode in value? Probably not. The odds are almost certainly against it. Doesn't mean it can't. And here's something that a lot of short-term traders forget. Let's say you short it and it does turn around. Well, if it does turn around and it starts to explode in value, there's a lot more distance all the way up here than there is down to here. So there'll be plenty of time to get into that trade. You know, it's okay to miss out the first 24 hours of a trend. You know, I mean, I know as traders we want to be perfect, but the reality is you're very rarely going to be. Bearish engulfing candlestick led to a massive sell-off here at a MACD cross with the overall trend. Furthermore, it happened right here in an area that had been support and resistance, so it all lines up. So always look out first before looking at small time frames. Going back to, let's go back to Bitcoin on the weekly chart. So remember the 30-ish thousand, 31,000 area? If we break that, then on the weekly chart, we're suddenly looking to the upside. So then we're looking to buy dips. Always let the bigger players push the market around. Your job is just to simply follow them. Just work your way down, see what the big traders are doing, and work your way down, find your entry points. Trading against the trend is the folly of retail traders, and it is the reason that this and psychology are the reasons why most retail traders struggle. In the next video, I'll talk about scaling in and out of your trades. Welcome back to Cryptocurrency Trading, Mastering Scalp Trading Strategies by Wealthy Education. In this video, I'll talk about scaling in and out of a trade. So, risk management is going to be the most important thing when it comes to trading. And in scalping, that's especially true because typically you're trading with larger positions on shorter time frames. And shorter time frames get rather noisy and messy. So the first thing that you should do is you should have support resistance levels plotted out before you put any trades whatsoever on. So as I'm looking at this chart, notice how these areas, and this will just be review, these areas tend to repeat time and time again. You know, this was an area that was support and resistance. Well, lo and behold, we bounced from there. This was an area that was support. We pulled back from there. Knowing this ahead of time is an easy way to set up what you can do with your trade down the road. So if you take this bullish engulfing candlestick, for example, you could lay that out and place your trades and scalp in and out as a result. But I'm putting this on the 1 hour chart. So let's go ahead and zoom down to the 5-minute chart. So I will stretch this out. And as I place that there, and we see signs of weakness there, if you decide to short for whatever reason, I'll even go to the 15-minute chart. You can say, hey, this is an evening star. So looking at this, you remember your entry would be there. The crossover's right there. This is a major resistance barrier on the 1 hour chart. Well, you're now on the 15-minute chart, right? So you're short and you're aiming for this area here. Let's say, and I'm going to use 100, be $100, $100,000, whatever, it doesn't matter. You have your stop loss just above here, like you would expect. So once you get here, you have a couple of choices to make. You can have profits. You can move your stop loss to break even. A lot of traders will just take profit. Some will maybe take half. So now you're down to 50 units, $50, 50,000, $5, whatever. Your stop loss is at break even. We break through here. Your stop loss moves down to here. Maybe you take profit there. And now you're down to 25. That's one way to scale out of a position that's working in your favor. However, let me ask you this. So these areas that you're paying attention to, what if instead of doing what we just did and maybe taking a half off there, what if you take your break even or your stop loss, move it to break even when you get down here, and then add $15, 15%, whatever. Adjust your stop loss from break even for that for the entire position. Well, you're going to get quite a bit more in profit. That's scaling in. Scaling in makes a huge difference in your longer-term return. That being said, there is the possibility that it comes back and it takes you out. And, unfortunately, as humans, our first thought is, well, I could have had all 100 here instead of breaking even. It comes down to probability. It comes down to long-term statistics. And if you can add to a trade that is working out, it will make you infinitely more profitable. It is not a comfortable thing to do, but it is something that unfortunately you probably will be forced to do if you ever want to truly be successful. You know, a lot of the biggest traders in the world, they're only right like 30% of the time, if that. But their winners, you know, far outrun their losers. So, you know, this is the Ethereum chart that we looked at the higher time frames in the last video. That's the 2000 level. We break down below there. So here's a question. On the 15-minute chart, you see that we're pulling away from there. Then we break a fresh new low. You decide to short. You decide to put a stop loss there. Well, then you start to look towards other support. And that would be your target. That's a nice risk to reward target. Again, you know, you would expect some trouble right around here. You could take off part, or once we break down below there, you can add 10, 15, 20%. Just make sure that once you add, and this is me personally speaking, there's no rule about this, but if you are adding, make sure that you don't lose any money. Make your worst case scenario is that you break even. But do make sure that the market is proving you correct if you are going to add to your position. There are other ways you can do this. You know, on a break of this support level here, you could say, all right, so there's the low. When we pull back here, I want to short. When we break this next fib level, I want to add to it. Stop loss could be on the other side of the fib. So some things to think about. And I will tell you this, unfortunately, there is no right or wrong way other than what you can psychologically handle. Do know that winners add to winning positions. They never add to losing positions, what is known as dollar cost averaging. All that means is you're trying to catch a falling knife most of the time. So only add when the market proves you correct. If it's telling you that you're wrong, you don't add to try to get a lower cost basis. It works in retirement accounts because you have 40, 50 years working for you, and a crypto account that has leverage, it'll blow you up rather quickly. In the next video, I will take a look at position sizing and the risk to reward ratio. Hello and welcome back to Cryptocurrency Trading, Mastering Scalp Trading Strategies by Wealthy Education. In this video, we'll take a look at position sizing and risk to reward ratio. First things first, risk to reward ratio. What is it? Well, risk to reward ratio is sometimes written like this. So what that means is you're risking 1 to gain 3. So let's say you're risking $100, you're trying to get 300. The reason why it matters is because psychologically we want to be winners more than losers. And a lot of traders will do something, and you see this a lot with like signal providers. They'll risk like 8 to try to get 2 or something, or like 2.5, okay? And when they do that, what will happen is they'll get something like a 91% hit rate because all they're doing is trading with the overall trend, and eventually, you know, that works most of the time. But eventually the trend changes or something happens in the market that gets everybody freaking out and you take a massive loss. So if you do it more like this, 1 to 3, risk 1, gain 3, this is what a distribution of, like an equal distribution of trades. Say there's 6 trades, 3 winners, 3 losers, right? I think you can already see where I'm going with this. So that's 9 minus 3. That's a positive expectancy of $6, right? If you only get half your trades right. Even if you get, let's just say, this happens. You get 4 wrong, and you get 2 right. Well, that'll be a total of 6. You're still up 2. That's only getting a third of your trades right. Now, let's take a look at somebody who risks, let's say they risk 3 to 1 and the other way. They're trying to scalp the market and they want high wins. So what happens is they get a bunch of wins in a row. They might get 4 wins. But they have to be 80% accurate minimum, in this case, to be up by 1. What happens if you're 60% accurate? Actually down 3. So that right there explains risk to reward. And it's simple. You should always look at a trade and go, you've heard me say it once or twice during this course, I don't know that I would have shaken that because resistance is right there just above. Here's a hammer here. And let's say you did take this. And yes, it broke that resistance, but you don't know that's going to happen. Then your entry would be, somewhere right around there. Well, notice how that isn't as long as this. So in other words, you're risking more than you're possibly gaining. Now, if that's your resistance barrier and this, isn't a resistance barrier and it doesn't look like it's going to cause some trouble, although I don't know why you wouldn't think that, but let's just say you didn't, then that's a little bit more reasonable. That's almost 2 to 1. As a general rule, you want 2 to 1. You don't need a ton of winners at 2 or 3 to 1 to make good positive expectancy. All of that being said, none of this matters if you don't manage your position size. Position sizes should be reasonable. They should never be so much that you're going to threaten the overall health of your account. As a general rule, you only want to risk 1% of your account or less. So every $100, you risk 1. There are people out there who will say 2%. I will tell you this, professional traders don't risk 2%, at least not initially. Now, that doesn't mean that you can't add along the way. We just went through scaling into a trade. You can really compound gains rather quickly by scaling into a trade. There's no need for massive amounts of leverage, especially in a market like crypto that, once it does take off, it's going to take off, pretty drastically. We've seen that multiple times just as it falls drastically. So never risk more than 1%. A lot of professionals will risk like 0.25%. I understand you're a retail trader and you are trying to make a little bit more money out of it, but anything over 1% starts to get in the realm of dangerous. Liquidity and slippage issues are also something you have to pay attention to in crypto. Basically, any coin that doesn't trade that in a liquid market, number one, you shouldn't own. But if you do choose to buy into it, make it an investment. For example, if you believe in chilies, you might buy chilies, but you're not trading chilies. You buy 1,000 chilies, 10,000, whatever it is you buy, and you're hanging on to that for a longer term trade. You're not scalping it. Scalping needs to be probably the top 10, maybe top 20 coins in general. Doesn't mean you can't do it in other places from time to time, but do recognize that you could run into issues of getting slippage. And slippage is just simply when you press the button, say you press a button in Ethereum at 1920, and your fill, a buyer, seller, or whatever, actually ends up being like 1918. You've been slipped $2. A completely liquid market won't have that very often, except for maybe news. So do keep that in mind as well. In the next video, I'm going to talk about probably the most important thing in trading psychology and emotion management. Hello, and welcome back to cryptocurrency trading Mastering Scalp Trading Strategies by Wealth Education. In this video, I'll have a few words about trading psychology and emotion management. Now, everything that you learn as far as technical analysis is concerned is fairly widely known. Let's put it this way. Traders and Goldman Sachs, JP Morgan, these huge funds, they all know what a shooting star is. They all know what support and resistance is. They know what a MACD crossover is. They all know this. What they have are what is known as risk managers. So, for example, let's say you and I are sitting at a desk at a trading floor in Singapore for one of the big banks, and we're trading crypto. If I lose a certain amount, and it will depend on the trading floor and the bank and a lot of other things, but let's just say that particular day, they don't want me losing more than 2% of my account. No, you may say 2%, that's not that much. Well, what if it's a $50 million account? So I lose 2% and I get a tap on the shoulder and I'm told to cut my position size. Well, there's somebody who is forcing me to do that. As a retail trader, you don't have that option. There are a lot of psychological traps that you can fall into, not the least of which is revenge trading. I can think of nothing more toxic than getting angry about a position and then trying to get your money back right away. Personally speaking, I don't know that there's been too many times that has worked out for me. Unfortunately, it does sometimes, and that only reinforces the bad behavior. Another common pitfall will be to be afraid of trading, to look at trading as, I'm no good at this, I'm going to end up losing money. I mean, you have to be able to pull the trigger. That can only be done by testing a system in a demo account or paper trading and truly understanding how it performs over the longer term. Yes, you will have runs of bad trades, or not even bad trades, but trades that go against you. But if you know that the average losing streak of your system is like 4 trades, but over the longer term you are profitable, that is something that you must keep in your mind when you're going through those times. Other common traps are to buy. Let's say you're bullish on Ethereum and it's been going straight up and it pulls back and you buy it here on this pullback and it falls and then you say, okay, well that should offer support, so I'm going to buy it here. And we fall there. It's like, oh, I'm getting mad. Well, there's definitely support down here, so I'm going to buy it again, and it keeps falling. All you're doing is compounding losses. It's if you're in a hole, stop digging. It's the best way to think about it. It's much different than buying down here, seeing we break resistance and adding, and seeing we consolidate and break above resistance and adding there. That's a completely different mindset, and that is how a winning trader behaves. You do need to understand your trading personality, and scalping is not for everybody. Some people are investors. Some people are swing traders, which might last a week or two. There is no right or wrong way to do it. You don't have to be a scalper. You may find that scalping doesn't suit you psychologically. The great thing about this course, though, is you can take a lot of this information, probably 99.9% of it, and just apply it to daily charts. Trading is fractal. It's no different. A pattern is a pattern. You should also keep an eye on what's going on with each trade. Keep a journal. Take a screenshot. So for example, let's say I do take this trade and I buy this pullback, based upon this previous support and resistance. We break there. I add. We consolidate here in this triangle. I add there, take a screenshot of all of that action. And then write about what you were thinking. You will over time begin to notice there are patterns that for you work. They may not work for me. There are studies where you can literally take 2 traders, give them the same system, one will outperform the other. And a lot of it comes down to psychology and discipline and things like that. Overcoming fear and greed in crypto trading is crucial. Don't get overly greedy. Don't become overly afraid. You want calm, measured moves. You don't want to buy into narratives. Follow price. Price is truth. For example, Michael Saylor was telling people, and I'm not picking on him, and it's just happened to be something that I remember, somewhere around here, how they should mortgage their houses and buy crypto. But you can see how that's worked out. You don't just buy into the cult-like nonsense. You don't buy into the latest narrative. You buy into what price is doing, because at the end of the day, it doesn't matter if crypto, let's just say Bitcoin will end up being what brings the second coming of the Messiah. It doesn't matter if the market doesn't believe it, you're not going to get the price to get out of it. So a little bit of temperance goes a long way. I would highly recommend keeping track of your trades, keeping track of your emotions, probably more so than your trades. Over time, you will notice patterns. You may notice things like, I trade horribly at the beginning of the week. I trade horribly during the Asian session. For whatever reason, I can't trade phantom. I have markets myself that I avoid like the plague, because I do trade other assets. For example, I hardly ever get natural gas right. So what's the solution? Just don't trade natural gas. You may find that, phantom is your Achilles heel. Don't trade phantom. When you look at your journal, you'll notice that your success rate in phantom is 20%, when in most other cryptos, it's going to be about 45, 50, 60%. Things like that, once they're written down, become self-evident, and they are very valuable pieces of information. So by all means, please keep track of your psychology, and psychology is a lifelong battle when it comes to trading. This video isn't going to do it. A course isn't going to do it. It's experience. It's really paying attention and being present in what you're doing. I truly hope you've enjoyed this course, and I wanted to leave with those comments because, quite frankly, that is going to determine whether you are successful or not. Figuring out what your strengths and weaknesses are is the hardest part of trading. Trading holds a mirror up to you in ways that most other things don't. So, again, I hope you enjoyed the course. Please watch it multiple times. Make sure you pound the information into your head and never stop learning.